Ever think about companies like Amazon, those giants? It's easy to picture them just bringing in billions and billions from sales, but have you ever actually wondered how they deal with their day-to-day costs, like before all that customer money really starts flowing in?
It's a really interesting point, and to understand that, we need to dive into the world of liabilities. They're absolutely key to understanding a company's financial picture, how it actually works.
Okay, liabilities. What exactly are we talking about here?
In simple terms, liabilities are the obligations a company has to pay others. They're basically debts. And today we're going to really break down a key difference: current versus long-term liabilities. We'll also dig into the different types of current liabilities and the nitty-gritty of how they're accounted for.
So if I'm an investor trying to decode a company's financial statements, or maybe a business owner keeping tabs on what I owe in the short term, or even just someone who's curious about how the economy ticks, understanding liabilities is essential.
Absolutely. It's fundamental. And for this deep dive, we're turning to a chapter that lays it all out, even using Amazon as a prime example.
Perfect. So let's start with the basics. What's the core difference between these two types of liabilities, current and long-term?
Well, the big difference is time. Current liabilities are essentially debts a company expects to pay off within a year from the date of its balance sheet. Or if their operating cycle is longer than a year, then within that cycle.
Operating cycle.
Right. Think of it as the time it takes for a company to, say, buy inventory, then sell it, and finally collect the cash. It's the whole cash conversion cycle. Current liabilities are very much tied to these everyday operations.
Okay, so the debts that keep the business humming along in the short term. What are some concrete examples of these?
Sure, we've got accounts payable, which is basically what a company owes to its suppliers, for stuff they bought on credit. Then there's notes payable. Think of these as kind of like formal IOUs, short-term loans, often from a bank, usually with interest.
Like a business version of borrowing from a friend.
In a way, yeah. Then there are accrued liabilities. These are expenses the company's already racked up but hasn't paid yet. Things like employee salaries or taxes due to the government.
Ah, those pesky taxes. Always lurking.
Exactly. Then there's the current portion of long-term borrowings. So any part of a long-term loan that's due in the next year gets recategorized and shows up as a current liability.
Makes sense. It's all about what needs to be paid soon.
Right. And finally, there's unearned revenue, sometimes called deferred revenue. This is when a company gets paid by customers before actually delivering the goods or services.
Okay, so they owe something in return, even though they already have the cash.
Precisely.
And what about long-term liabilities? What sets them apart?
As you might guess, long-term liabilities are debts a company doesn't expect to pay off within the next year. They're usually tied to funding bigger, longer-term things, like building new factory or buying a whole other company.
Ah, the big moves.
Exactly. Now, the source material we're looking at dives deeper into long-term liabilities in a later chapter, so we'll save that for another time. Today, we're focusing on those immediate short-term financial obligations.
Got it. Short-term focus for today. Now, I noticed the chapter brings up Amazon early on. Why is that?
It's a brilliant illustration of how massive these current liabilities can be, even for a global powerhouse. In their fiscal year 2016, get this, over 68% of Amazon's total liabilities were classified as current. We're talking $43,816 million out of $64,117 million. That's serious money.
Wow, over two-thirds due within a year. That really puts it in perspective.
Yep.
Let's break down some specific types, starting with accounts payable. For Amazon, with all the stuff they buy and sell, what exactly falls under this category?
Think of it as the money Amazon owes to all its various suppliers for all that merchandise, everything from those cool gadgets to basic household stuff, and not just for resale, but also for their day-to-day operational expenses. At the end of 2016, Amazon's accounts payable totaled over $25 billion.
$25 billion. That's mind-boggling. So how can we tell if they're handling these payables well? There's a term for that, right? Accounts payable turnover.
You got it. Accounts payable turnover tells us how many times a year a company settles its average accounts payable. A higher turnover usually means they're paying their suppliers faster. It's calculated as purchases from suppliers divided by the average accounts payable.
Okay. And how do we figure out those purchases from suppliers? That's not just one line on a financial statement, is it?
You're right, it's not always straightforward. For companies like Amazon that sell goods, we often have to calculate it indirectly. One way is to look at changes in inventory levels. Beginning inventory plus cost of goods sold minus ending inventory. That gives you the purchases.
Got it, like a puzzle, piecing it together.
Exactly. But the chapter gives us a simplification. If the beginning and ending inventory amounts aren't drastically different, we can use the cost of goods sold figure directly. Makes things a bit easier.
Ah, helpful shortcuts. So essentially, it's about how quickly they move inventory compared to how long they take to pay suppliers. What did those numbers look like for Amazon?
In 2016, Amazon's accounts payable turnover was 3.92. That translates to a days payable outstanding, DPO, of 93.1 days. Basically, on average, it took them about 93 days to pay their suppliers.
93 days. Is that considered long or short in the business world?
That's where comparisons get interesting. In the same year, Walmart's DPO was 40.5 days and Target's was 55.1. So Amazon was definitely taking longer.
Significantly longer. Why would they do that? Wouldn't a longer DPO be seen as, I don't know, maybe a sign of trouble?
Not necessarily. A high turnover, meaning a short DPO, is generally seen as a good thing, a sign of good financial health. But for giants like Amazon, they can leverage their size and market dominance.
So they can kind of dictate terms.
Exactly. They can stretch out those payment terms with suppliers, hold on to their cash longer. It's like using their suppliers' money interest-free. While it might put some pressure on smaller suppliers, they often feel they can't afford to say no to Amazon. So in this case, a longer DPO isn't necessarily a weakness, but a strategic move.
Wow, it's fascinating how those power dynamics play out. All right, let's shift gears to notes payable and the whole interest thing. What's the gist here?
Notes payable are essentially like formal IOUs. They're written promises to pay back a certain sum, usually with interest, within a year or an operating cycle. Companies often use them to cover immediate needs like buying inventory.
Got it. So how does the accounting for these notes work, especially with interest accruing over time?
The chapter uses a great example. Imagine a company buys $8,000 of inventory on January 1st, 2018, and instead of paying cash, they sign a one-year note at 10% interest. Now, let's say their fiscal year ends on September 30th. They need to account for the interest that's built up from January to September. Even though the note's not due until the next January, the company needs to recognize that expense.
So they're recording the expense as it happens, not just when the final payment is made.
Precisely. It's the accrual accounting principle in action. To calculate the interest, we'd take the principal, $8,000, multiply it by the 10% interest rate, and then by the portion of the year that's passed, which is 9 months out of 12. That gives us $600 in interest expense.
So by September 30th, their balance sheet would show not only the original $8,000 note payable, but also an extra $600 as interest payable. What happens when the note comes due in January?
At that point, they need to pay back the $8,000 plus all the interest for the year. Since they already recorded $600, they just need to account for the interest from October to December, another $200. So on January 1st, 2019, they pay out a total of $8,800. The principal, the accrued interest, and a final bit of interest.
Okay, so the interest expense gets recognized bit by bit, even if the big payment comes at the end. Now, the chapter also talks about the current portion of long-term debt. What's that all about?
Right. Sometimes companies take out loans that are meant to be paid back over several years. Those are long-term debts, often used for big investments. But each year, the portion of that debt that's due within the next year has to be reclassified as a current liability.
So even though it's part of a long-term loan, if it has to be paid within a year, it becomes a current liability.
Exactly. It needs to be paid using the company's current assets, like cash, within that short time frame. The source mentions that Amazon, at the end of 2016, had $7,694 million in long-term debt. But the part due within the following year, $1,056 million, was lumped into a category called accrued expenses and other, which also include other things.
Interesting. It all comes back to when that payment is due. All right, let's move on to accrued liabilities. We touched on those briefly, but let's dive deeper. What are some key examples besides those salaries and taxes?
Accrued liabilities come from the idea of accrual accounting. Basically, expenses are recognized when they're incurred, not necessarily when the cash is paid out. So you might have expenses that have built up, like rent or utilities, but the bill hasn't come in yet. Those are accrued liabilities.
Okay, and Amazon had a large balance in that accrued expenses and other category.
Right. Yes. As of December 31st, 2016, it was $13,739 million. Pretty big chunk.
Right.
And as the footnote explains, it's a mix of different things. Liabilities for those unredeemed gift cards, lease obligations, the current part of their long-term debt, and some other operational expenses they've incurred but haven't paid yet.
It's like a catch-all category.
Yeah.
Let's look at some more specific examples. What about payroll liabilities? We know those are important.
Payroll, which is basically employee compensation, is a major expense for most businesses. Salaries, wages, commissions, bonuses, it all adds up. And when a company records this expense, it creates different payroll liabilities at the same time.
Like the taxes that are withheld from employee paychecks.
Exactly. There's employee income tax payable, which is the income tax withheld on behalf of the government, and FICA tax payable, which covers Social Security and Medicare taxes. Both the employee and employer contribute to those.
Right, and the employer also has their own payroll tax responsibilities.
Absolutely. Employers have to match the employee's portion of FICA taxes. They also pay federal and state unemployment insurance taxes. All of these create liabilities that need to be tracked and paid to the government on time.
Okay, it's not just about paying employees, but all the associated taxes too. The chapter also mentions accrued warranties payable. How do warranties create a liability?
Warranties are basically promises to repair or replace faulty products within a certain period. It's a way to give customers confidence in what they're buying. And for companies, they need to account for the potential cost of those warranties.
Makes sense. It's like setting aside money for those potential future costs.
But how do they know how much to set aside?
It's an estimation game. They use historical data, past experience with product defects, to estimate the percentage of products that might need warranty service.
Ah, educated guesses based on past trends. Exactly. Let's say Black & Decker estimates a 3% defect rate on their $100,000 worth of sales. They'd record a $3,000 warranty expense and create a corresponding accrued warranties payable. As actual warranty claims come in, they reduce that liability.
It's like a reserve to cover those potential future repairs or replacements. Now let's switch to unearned revenue. This is when a company receives cash before actually delivering the goods or services. How does that create a liability?
Think of it as an obligation. They have a customer's money, but they haven't fulfilled their side of the deal yet. So it's not considered earned revenue until they deliver the goods or provide the service.
Okay, they owe something in return. And we saw that Amazon had a big chunk of unearned revenue on their books. Where does that mainly come from?
A lot of it, according to their footnotes, is from those upfront payments for Amazon Prime memberships and Amazon Web Services, AWS Cloud Computing.
So if I pay for my Prime membership for a whole year up front, they don't count that as revenue all at once.
No, not right away. They have to recognize it over time as they provide the service. So every month, they'd recognize a portion of that upfront payment as earned revenue.
Okay, so even though the cash is in hand, they only record the revenue as they earn it. Makes sense. Now, let's talk about contingent liabilities. This sounds a bit more complicated.
Contingent liabilities are like potential liabilities, those looming what-ifs. Think lawsuits, tax disputes, or even potential environmental damage claims. They might become real liabilities, but it depends on what happens in the future.
So they're not sure things, but they could have a big financial impact.
Exactly. And transparency is key here. When it comes to contingent liabilities, the general rule is, when in doubt, disclose. The company should at least mention these potential issues in the footnotes to their financial statements.
Right, so investors and others know about the potential risks.
Precisely. Now, the FASB, which sets accounting standards in the U.S., has specific rules for when a company has to actually record a contingent liability on their balance sheet.
So when does it cross the line from just a mention in the footnotes to an actual recorded liability?
They have to accrue a contingent liability, meaning actually record it. If it's probable that a loss will occur because of this past event, A and D, if they can reasonably estimate the amount. So if a company's facing a lawsuit and based on legal advice they think they'll probably lose and they estimate the damages will be around $1 million, they'd have to record that liability.
Okay, so both probable and estimable. What if one of those conditions isn't met? What if it's possible they'll lose the lawsuit, but not necessarily probable, or they can't really estimate the damages?
In those cases, they generally just disclose it in the footnotes. They explain what the situation is, how likely they think a loss is, and if they can, give a range of potential amounts. It's all about being as transparent as possible, even if the outcome isn't certain yet.
And the chapter gives a real-world example from
Yeah.
Amazon, right? Something about a lawsuit.
Right. Note 7 in their 2016 financial statements talks about a patent infringement lawsuit filed against them by a company called Big Baboon, Inc. Amazon said they'd fight it, believed the claims were baseless, but they also acknowledged that the outcome was uncertain.
So because it was still up in the air, they just disclosed it in the footnotes, right?
Yeah, exactly. Now, our chapter also gives an international perspective. It talks about IFRS, the accounting standards used in many other parts of the world, and their approach to contingent liabilities is a bit different.
Different how?
IFRS defines contingent liabilities as possible obligations. They tend to be more conservative and usually require disclosure in the footnotes, but they don't typically allow for them to be accrued on the balance sheet.
So under IFRS, it's harder to actually record a liability for these potential future losses.
That's one way to put it, yeah. Instead of using probable, IFRS uses the term more likely than not. So the chance of a loss has to be greater than 50% for them to record a provision, which is their version of an accrued liability.
Okay, a higher bar to clear.
Yeah.
And the chapter brings up the Volkswagen emissions scandal as an example, right?
Exactly. Volkswagen, reporting under IFRS, faced huge potential liabilities because of that whole rigged emissions testing thing. For the costs they thought were more likely than not, like vehicle repairs, they recorded provisions on their balance sheet. But other potential costs, like further penalties from investigations, those were just disclosed in the footnotes because the outcomes were still uncertain.
A real-world example of those different accounting standards in action. Finally, the chapter wraps up with a summary problem focusing on Estee Lauder. What's the main takeaway from that?
It's a great way to tie everything together. The problem gives a bunch of different scenarios. Unpaid salaries, warranty obligations, royalties due, a portion of long-term debt coming due, and a potential tax liability being disputed. The point is to show how each of those would be handled on Estee Lauder's balance sheet.
So it's about applying all the concepts we've discussed to a real company's situation.
Exactly. Figuring out what's a current liability, what part of the long-term debt is reclassified, and whether a potential obligation like that disputed tax liability is recorded on the balance sheet or just disclosed in the footnotes.
Okay, so a practical application exercise. As we wrap up this deep dive into current and contingent liabilities, what are the absolute key things our listeners should take away?
The big one is really grasping the difference between those current and long-term liabilities. Then there's understanding accounts payable turnover and days payable outstanding. They give you insight into how a company manages its short-term cash and relationships with suppliers.
And those calculations can be a bit tricky, but we broke them down.
We did. Then there's understanding how notes payable and their interest are accounted for over time. And the whole concept of accrued liabilities and unearned revenue, they're all about recognizing expenses when they're incurred and revenue when it's earned, even if the cash flow happens at a different time.
It's all about matching those revenues and expenses.
Yes. And finally, knowing when a contingent liability has to be recorded on the balance sheet versus just disclosed in the footnotes, that's key to understanding a company's potential future obligations.
So for our listeners who are now armed with all this knowledge, how can they use it in the real world?
It really gives you a sharper perspective when you're looking at a company's financial health. You can assess their ability to handle those short-term debts, you can analyze how efficiently they're running their operations, and you can get a better sense of those potential future financial impacts, from past events.
It's like having a new set of lenses to view financial statements.
Exactly. I'd encourage everyone to take a look at the liability sections of real company financial statements. See how Amazon or other companies you follow handle these things.
Excellent advice. Now here's a final thought for you, our listener. How might a sudden, unexpected event, like a major lawsuit ruling or a big economic downturn, affect a company's current liabilities, and how would that impact their overall financial stability in the long run? It's definitely something to think about. We hope you found this deep dive insightful, and we'll see you next time.